And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Luke Smith, where's your Raiders jersey?
Oh, you know what? I don't look good in green. I've got the green pants on, so I hope they get up. It'll be a great send off for the big man.
It'd be absolutely fantastic. So
good.
Fingers crossed for a great result tonight. And of course, we're hoping for revenge over the match during the finals series last year. Which we won 3 times before the referee finally gave it to the Broncos.
Who could ever forget that game? Yeah.
It was a shocker. Anyway, let's not dwell on the past. Today we're addressing a very pertinent question because a lot of the time we focus on investing in shares and in managed funds. But what about fixed interest assets? People believe they're safe. Are they really?
Well, I think it's the question is it depends, like most things. I think really what I want people to take from today is to not make the assumption that somebody like me says fixed interest. I find the retail consumer hears term deposit. Now, a term deposit has a fixed rate of return for a set time frame, and it doesn't get revalued over the time frame that you hold it, and a lot of people have comfort in that, and you get a commensurate rate of return for the time that you commit it. And really, today's about talking about, well, what is risk and what matters and what could influence the value of your fixed interest assets. Because the first thing I want to get out there is nothing is guaranteed. The word fixed is a bit of a misnomer because you can have a fixed interest asset and its value can fall. And it can fall for a range of different reasons. And that's what I want people to sort of finish the show with today, is a very broad understanding that I see the word guaranteed or capital protected tied into the word fixed interest. There's this perception that nothing bad can happen, when in actual fact we saw firsthand when interest rates rose very quickly 2021, we saw a lot of bonds and a lot of fixed interest assets fall. And it was the first time in, I think, 40 years where Aussie shares and fixed interest assets fell at the same time. Now, why did they fall? If we use a term deposit as an example, if you buy a term deposit now and you lock it in for 5 years, if we see 2 or 3 rate rises which are expected, it's going to take a very long time for you to be able to increase the return from the time frame that you've selected, because you will miss out on any future rate rise because you've committed for the duration. Now, that word duration is very important because the longer the duration, the greater the impact a change of interest rates can have. So if we think of a 5-year term deposit, if we took one out today and we see 2 rate rises over the remainder of this calendar year, if we have a long-term fixed interest asset, its value is going to go down. It will go down because any time somebody values an investment, they want what is on offer at the time they buy it. Now, if you can't change the rate because you've committed for 5 years, you have to bring down the price to affect the rate of return. Similar to a mortgage, a rental house. If you rent your house for 12 months, you can't change the lease halfway through because your neighbour charges more. You have to wait to the end of the lease. So I find people see that in their head as well. So duration is the time that you've committed the investment. That can be good or bad. In the current environment, we want short duration. We want rolling 3-month term deposits over 2-year term deposits, because if interest rates rise during the year, we want to be able to reset our money at a higher rate of return in line with what happens with interest rates. When the interest rates get to the top of the interest rate cycle, like, you're not going to go any higher, then we want to buy 2 and 3 year rates, because if they fall, now we're protected when they come down. So we want to be flexible on the way up and protected on the way down. So the word safe is very, very dangerous in the fixed interest sense. And that's really what I wanted people to just take away from today, is that I see a lot in appointments. People say, oh, well, I'll buy bonds. They're guaranteed, they're safe. Well, interest rates can have an effect on their value, and that can be both good and bad. So people need to understand what they're buying into, the quality of the bond, the time frame of the fixed interest investment, and that may not be a bond, that could be anything. And then also consider, well, what are interest rates likely to do going forwards? And a good illustration of measuring that at the moment is a 3-month, 6-month and 12-month term deposit is very, very similar. So there's no incentive to commit more money over 12 months than there is over 3 months or 6 months. And we know that Albo's pushing inflation up, so highly likely that interest rate rises could come. So we want to be short term at the moment because we want to be able to reset if interest rates go up. So fixed interest is there as the safer part of the portfolio because there's a perception that there is no valuation risk when actual fact there is. So always remember, buy good quality investments that are well diversified and understand where they are. Because you can buy Australian bonds, that's great, and you get a rate of return. You go and buy some Italian bonds and you might get 10 or 15%. Now, why are they paying you 10 or 15%? Because you are riding the lightning. Because you may not get your money. You may not get a payment. It might collapse. So you have to understand what is the risk I'm taking on, and then what is the time frame that I'm committed to, because getting out during that time frame could be good or bad. So there's a lot more to the fixed interest sector than people realise, and I just wanted to point out some of these factors that influence valuations, because in 2021, when fixed interest fell in value because interest rates rose very quickly, people were shocked. Because I say fixed interest, and people hear term deposit. And there are a number of things that you can buy that are not term deposits in that space.
And of course, a term deposit is a very simple thing. You put the money on deposit for a fixed period of time for a fixed interest return. And at the end of that period of time, whatever money you put into it, say you put in a $10,000 deposit, it's still $10,000 at the end of it.
Yes.
But if interest rates rise during that fixed term, you're missing out on a potentially higher return. So even that is causing you to suffer not exactly a loss, but not as much of a gain as you might have otherwise experienced.
Yeah.
But when we move beyond term deposits, you start talking about things like bonds, and there are other instruments as well.
Yes.
These are portable in the sense that, unlike a term deposit, you can buy and sell them at any time.
Yes, and they're revalued regularly.
Yeah.
See, a term deposit's not revalued. If a term deposit was revalued over the time frame that an investor held it and interest rates moved up, the value of the term deposit would fall and people would be in tears. So it's about understanding the inverse relationship between interest rates going up and the value of a bond coming down, and the rate of change is influenced by how long you have committed the money. So there's a lot to the fixed interest space. It's not just term deposits. And like anything, people say, well, give me the best rate of return in fixed interest. But I know that they're not willing to take on the risk if they understood what they were bringing to the dance. It's the equivalent of saying, well, I'd love to eat McDonald's 7 days a week, just make sure I don't get fat. You sort of go, well, just do it on the weekend and you'll be okay. You know, so I think people need to understand the varying ways that they can invest their money, but also understand the location of the investment, the time frame of the investment, and the quality of it. So you get rewarded by taking on more risk. You can take a government bond, Australian government, perceived as very safe, wonderful. You can then get a corporate bonds where you're taking a bond from a company. Now you're taking on more risk depending on what that company is. So you want a higher rate of return to be rewarded for the risk you're taking on. So they always work in unison, rate of return and risk and time. So those three things are going to drive the outcome that you get, the quality of what you buy, the rate of return, and also check how it's paid. Is it paid annually? Is it paid monthly? Is it paid quarterly? What is the liquidity? Can I get out of it? So everybody's seen The Big Short. We saw what happens with US housing and mortgage funds. As an example, when the US property market collapsed, nobody could get out of a mortgage fund. So the fixed interest space, be careful. If something looks like an amazing return, you could have corporate bonds in Greece. Now, nice place for a holiday, not a great place to be buying bonds. So understand the risk you are taking on with the rate of return that you see on the internet, on the telly, online, on Facebook, in a chat group. Nothing ever comes for free, and you have to stop and think, they're going to pay me 10%. So if they're paying you 10, what have they got to make to pay you 10? Because if it was that easy, everybody'd be doing it. And I point that out because I'm sent stuff all the time. Oh, what about this and what about that? They're going to give you 12. What do you think's going on in the background to give you 12 when cash is at 4? So be mindful that if it glitters, it's not gold. And it doesn't have to, you don't have to get bit by a snake to know it's a snake. It can look, it can slither. You don't have to get bit by it. So be aware, be open-minded, and be fair and reasonable, because people don't have the risk tolerance they think they have until things turn bad.
Luke Smith from Envision Financial is with me in the studio today, and we're talking about fixed interest assets and just how safe are they. Luke Smith from Envision Financial is with me in the studio today. We're asking about fixed interest assets and are they in fact as safe as people seem to believe they are? So Luke, we've covered a bit of territory today. What should investors consider before allocating some assets into fixed interest?
Yeah, so think about, well, what am I trying to achieve? Do I want capital stability? Do I want regular income? Do I want limited volatility? Why am I doing it? Because you can buy really sexy fixed interest and really boring fixed interest. And as we know in life, anything sexy is either expensive or dangerous.
Or both.
Or both. And you can apply that to any facet of life. I don't care what it is. Are we buying direct bonds, or are we going to go and buy them through a managed fund or an ETF? Because you can buy a collection of fixed interest assets through an ETF, which is a really good way of diversifying what you buy and not having to be singular in your exposure, which can be a very good way to get diversity. Think about the quality of who's issuing the bond. Is it the government? Is it a company? Is it a country? What's my location? Is there currency risk? So think about the time frame. What's my duration? Duration is just a fancy way of saying how long. So duration matters, because if interest rates go up, the value of an asset will go down, and vice versa. At the moment, we want short duration because interest rates are rising. When we get to the top of where interest rates are, then we want a longer time frame to lock in a return. So we need to think about our liquidity. Can I sell it? Can I get out of it? How much of it is traded? If you buy something that's fixed and something bad happens, that could be really bad. If you bought something through an ETF that it's liquid and you can trade out of it, think about that, because you need to consider the worst case scenario and then pair the fixed interest assets you buy with the other assets in the portfolio so you maintain a suitable level of risk. So diversification is key. Understand the tax treatment, understand how the payments are made. Are you getting a monthly payment of income, quarterly, semi-annual, annual? Is it done at the end of the period? Because that will all affect the rate of return and what you use that fixed interest asset for. And always check what you're buying so that you understand the objectives, the terms, the conditions, or the PDS, the product disclosure statement that will be issued with all assets in that space.
So what's the place of fixed interest assets within a reasonably well-balanced portfolio of investments?
So it will sit within the defensive portion of your portfolio. So if we think about a traditional industry fund, you might run 70% in growth assets and 30% in defensive assets. And this is where your bonds are your fixed interest, your converting preference shares, your hybrids, all of those sorts of things will be in that space, because we want limited volatility, a regular income stream, good, resilient, quality assets. And then we have our growth in property, international and Australian shares. So make sure that you understand that not everything is safe, and there are varying degrees of risk that you can take on in every sector. And let's not assume that the word fixed interest means term deposit when you hear it.
No, it covers a lot more territory than just a simple term deposit, although that's a good place to start, because we all understand that.
Great place to start. They have their place as well.
Absolutely. Well, Luke, that brings me to the point where I need to ask you, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. It's Envision with an E. We've got the podcast, The Strategy Stack, and Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got all of our backlog of shows. And someone said to me the other day, there's over 400 shows on there, which is Actually quite frightening.
And I'm on most of them.
You're on a big block of them, I tell you. And we've got Smart Money Strategy, your ultimate guide to financial planning, where there's an entire chapter on asset allocation and what different levels of risk mean.
Fantastic. Smart Money Strategy available in all bookstores and also online. I know it's not quite Christmas yet, but it's always a good stocking stuffer.
Always good for stuffing a big stocking.
Indeed. Luke, thanks very much.
See you next week.
We'll catch up with you again next Friday afternoon at the same time once again when Luke Smith joins me in the studio straight after the 4:30 news update once again to talk financial matters once more. It's about 3 minutes to 5 now on 2CC. It's Canberra Live, and coming up after the 5 o'clock news,